You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. That music means it's time, once again, for the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all of the interesting developments and all of the strategies that you guys can use in the world of options and how you guys can apply them to your own clients' portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you're new to the program, first off, welcome. And secondly, you missed quite a bit, so I encourage you to check out the archives. And there's a lot of great episodes, a lot of great interviews, a lot of great debates and discussions here on the Advisor's Option program. Easiest place to find all that, of course, the mothership, theoptionsinsider.com, or just search for the Advisor's Option in your favorite podcast provider of choice, iTunes, your TuneIns, your Stitchers, Pocket Cast, etc., so on and so forth. It's pretty much on all of them. If that's all too much for you, just grab our mobile app. It's in there as well, and you get access to the full archive, whereas some places like iTunes, they may limit you to the, let's say, the most recent episode, something along those lines. So check it out. I think you're going to like what you hear. And of course, whenever you're listening, wherever you are, send us your questions, your comments. We do love to hear from you guys. We got a few of you guys we want to rotate into the show again in a little bit in our office hours segment. Before we get to that, let me welcome on my cohorts, my partners in crime. Let's go in order of reverse proximity, so distance. So let's start off with Mr. Randy Swan, the co-founder of Swan Global Investments, beaming in all the way from scenic and sunny and tropical Puerto Rico. Randy, welcome back to the Advisor's Option program, sir.
It's great to be back. I definitely missed the cold weather. That's why I'm actually flying to Salt Lake City tomorrow to ski.
You missed the cold weather, huh? Well, it's one of you at least out there. Actually, it's been pretty mild here in Chicago. It seems like we always start the show off with a weather update. It's kind of fun. I think it's because there's usually such a disparity between where you are and where we are when we're recording the show. These days, not so bad. It's in the 50s or so in the Options Insider studios here in Chicago. So that's not too bad compared. It's no 80 plus and sunny like it is in Puerto Rico, I'm sure, but still not too bad, all things considered. And also joining us over there from the Swan HQ, I'm not sure if he's in Puerto Rico or if he's in Colorado or somewhere else. So let's find out. Is Mr. Mark Odo. the Director of Investment Solutions over there at Swan Global Investments. Mark, welcome back to the program. And where are you beaming in from, sir?
Well, I'm actually based in New York. That's where I am these days. So none of the above from your previous answer.
Kind of splitting the distance there. I like that. Halfway or so,
Exactly.
maybe a little more or less one way or the other. But we'll count it as half. All right, and last but certainly not least, I am also joined by the man holding down the corner office over there at the CBOE, the Director of Education at the Options Institute, and the author of the other seminal tome, Options for Advisors and Institutions, Mr. Russell Rhodes. Russell, welcome back to the Advisors Option Program, and where are you beaming in from today?
I'm at work. I'm at the exchange. I know that's a rarity.
It's not as exciting as your usual destination, sir.
No, I mean, this is the best job in the world when I don't have to come into the office, but I had to come into the office today.
Yeah, you've been all over. You've been hither and yon, London, Warsaw. I hear tale that you're going to Mexico City in a little bit. We'll get to that in a little bit, but now let's get on into the hot developments in the world of options and advisors. This is time for the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody. Like the man said, this is the portion of the show where we break down the hot developments in the world of options and advisors. We know you guys are out there. You're busy. You don't have time to keep up on the latest developments in the world of options that pertain to you, so we do it for you. And the big thing on the docket these days, surprise, surprise, is just the continuing evolution, the fluidity of what we thought was relatively settled regulation in the options space. If you listen to this show over the past year or so, listeners, you know that a big topic, a big cause for concern with a lot of the options-oriented advisors out there was the fiduciary rule being put in by the Department of Labor, not the least of which because, of course, in that buried inside that lengthy fiduciary proposal was a list of what effectively amounted to approved assets. And you know, whenever you have a list, you're going to leave something off. And what they did leave off in that sense was listed options. So listed options at that point were effectively banned for IRA accounts, which is the lion's share of the use case for many of the audience of this program, which, of course, the advisors and their clients. So that was, of course, a big cause for concern. It seemed like it was finally remedied about a little over a year ago, a little less than a year ago, I should say, back in April of last year. It seemed like they had finally solidified the language they had included after an extensive lobbying process by the industry, part of which we detailed on this program with Joe over there from OCC. They finally saw the error of their ways. I never actually heard it spelled out to me if it was just a sin of omission or if there was actually some attempt on their part to ban options. I guess we'll find out because now with the new administration, all of that is back in the air again, including the Department of Labor fiduciary rule. The Trump administration just last week put through an executive order that essentially is calling that April 10th deadline, which is when the bill was supposed to take into effect, or the legislation was supposed to take effect. Call that into question, saying if they don't think that this bill is going to be suitable for their purposes by that time frame, then it shouldn't go into effect. So, of course, what does that mean? It's kind of very vague language, and this has left the industry up in arms. They, in fact, in their executive order, they have an explicit mandate to delay the rule's April 10th implementation date if they feel that date is, quote, likely to harm investors by reducing access to financial advice and retirement investment products. And they also wanted to review whether the scheduled implementation date has resulted in industry disruptions that will adversely impact retirement investors. So there's a lot of debate now going on about what this means. Are we going to see this rule completely kicked to the curb? Is it going to be changed somewhat? Are, in the course of these changes, are options going to be back on the chopping block again? This is really, I think a lot of people are, not surprisingly, a little bit concerned about this. Of course, we also have never missing an opportunity to chime in on a bit of financial regulation. We have, of course, Senator Warren, who also reached out to a lot of financial firms saying, how do you feel about this change? Were you ready for the proposed April deadline? And surprisingly, a lot of firms, I think seemingly similar to what we saw with the Dodd-Frank, where a lot of firms said we've already gone so far to comply with this, it'd be a pain to dial it back. we saw actually an interestingly similar response coming through, again, filtered through the lens of Elizabeth Warren's office, where they clearly have an agenda on this. But still, that aside, there were a lot of firms were coming in, including BlackRock and TIAA, saying we support the current rule the way it's designed, and we've spent money to comply with that. We don't really want to dial it back. So it's a lot of interesting competing agendas at work here, competing viewpoints, competing perspectives, and as always, sometimes lost in the middle there could be the purview of the products we all hold near and dear, which are options. So there's a lot of questions here, and it's a lot of still unknowns, but I think it's worthy of at least kicking off the conversation here about it. I'm sure we'll have a lot more of this in the future. So first off, let me toss it to. Actually, before we do that, Mike, since you just came back, I tossed it to you at the top of the show. You weren't there, so let me just toss it. Let me just pretend I toss it to you right now, and you say, "Welcome to the show." Go ahead, go for it.
Great to be here, Mark. In terms of everything that's going on, the fact that they're considering not having options in an IRA, it's one of those things that sounds almost ridiculous enough that our government might pass it. But it bothers me a lot that they allow improper allocations, meaning that you could put everything you wanted in a tech stock in theory, but yet you're not allowed to hedge it with an option. And that's bothersome to me. Now, in terms of does the spirit of the law, the idea of what they're trying to do, it seems, and let's just be optimistic for a second, what they're trying to do, it seems to me, is that they're trying to have the advisor put the needs of the client first and align the needs of the client with the pay structure of the advisor. So that way the advisor's not thinking, oh, I can get a way bigger payout if I sell them this fund, even though it's not the best for them. But the reality of it is that hopefully you're with an advisor who's like that in the first place. If not, I know a great guy. His name is Mike that can help you along those lines. But my point is that I think we really need to work together on this, us being our industry along with the government, because there are some problems. There are a lot of abusive advisors that no one would even know, that a lot of clients wouldn't even know what the advisor's taking. Just because it's such a complex language to a lot of people who aren't in the business. So I do think there needs to be regulation, but I don't know if I'm very concerned that just with a long history of our government over-regulating and improperly regulating, that it's not going to be done right. So my hope is that we can work together on this and we can get it so it's right.
Yeah, I think this original proposal, the Department of Labor, I think was kind of almost the definition of unintended consequences. I agree with you. There was some, well-intentioned efforts behind it, like there is with a lot of regulation. And then we saw, as a result, the unintended consequences of effectively banning options from retirement accounts, which no one, I think, wanted. I still don't know. Like I said, I still don't know if that was by design or by accident. But it seemed like no one wanted it. It was just a mistake on their part, which could have potentially harmed a lot of people out there who rely on these accounts to protect and preserve their retirement savings. So, yeah, unintended consequences seem to abound here. But you're right. The spirit of the law, I think, is worthy of reinvestigating at the very least. Randy, same question for you. You've obviously been, not just you had your big financial advisor forum last year in Puerto Rico, where, of course, this was the hot topic of conversation. But since then, you've been doing the rounds with a lot of your 10th box events and meeting with advisors on a more local level. First off, what are your thoughts on this whole DOL proposal rearing its ugly head again after we thought it was settled, thought it was done and behind us? And then also, what are you hearing, at least anecdotally, from a lot of the advisors you're talking to? Are they up in arms? Are they concerned about this as well?
Well, let's go back to the beginning. I know we talked about last year a lot. I mean, fundamentally, we want customers and clients to have choices in their investments. We don't want to be limited too much. Obviously, there was some level of abuse or potential for abuses in what individual clients or customers were being charged. So we'd like to be able to fix that. But ultimately, I always go back to the individual client at the end of the day. The consumer of goods and services really needs to be on the lookout and do their own due diligence and be responsible for making sure they're paying a fair and adequate rate. I would probably lean towards less regulation, obviously, than more, just because of what we talked about. The law of unintended consequences always seems to go much further than they need to do, which, of course, is what we're talking about as it relates to would they inadvertently ban the use of options in IRAs.
Yeah, it's one of these areas where there is so much middle ground to explore. But you're right; the unintended consequences do always seem to, for some reason, they always seem to strike at options. I don't know why that is. Maybe we're just the unlucky product category. I don't know. But either way, you're right. The unintended consequences do seem to ripple over to this end of the pond on a somewhat alarming frequency. That said, Mr. Rhodes, I know even though you're traveling hither and yon and promoting the book on the book tour and everything else, I know you keep one ear to the ground when it comes to all things regulatory, particularly as it pertains to this space, the advisor space, which I know is near and dear to your heart, hence your weighty tome on the subject. What are your thoughts here on this whole DOL thing, this whole DOL ball kind of being kicked back into the air again, and what it means for advisors and asset managers out there?
Well, it's being kicked back into the air, as you put it, but I don't think that those of us in the option industry have to worry about too much, because when this initially got thrown out there, the OIC jumped all over it, took a contingency of people to Washington, D.C., talked to the powers that be, and things got changed around and righted very quickly, which makes me think that all of this was kind of an omission and something they hadn't thought about. And the second that that this was highlighted, it got fixed. So I feel like this is an issue that is it should be behind us. I mean, you never know, but I think this one's behind us.
I thought that too after the initial, like you said, the initial foray from OCC and others when they did their aggressive array of lobbying to try to educate people on this fact. And it seemed like they got the message. And then for a while there, they seemed like they were going back on that, which made me seem like maybe they didn't get the message, or maybe the message they were trying to send was a different one than we initially assumed. But then they ended up implementing it. So at the end of the day, I guess we suppose we'll never know. I guess we'll see in the future here if they attempt to go at it again, they take another tilt at that windmill, then we know there's someone over there who's got an axe to grind when it comes to options. And then I guess maybe we'll be better armed for that knowledge. But either way, I wanted to kick it off with this. I know we don't really know a lot yet because it just literally happened about a week ago. But that said, this is obviously going to be, I think, taking up a lot of oxygen in the room here in the advisor realm for at least the next few months. The deadline's in April. There's no way anything is going to be, as one of the people pointed out in one of the articles I was reading, they don't even have a head of some of these departments that have to review this yet. They haven't been approved yet. So there's no way any of these reviews can be done, let alone any of these reviews completed without someone on the head of the department to sign it off. So it doesn't seem like any of this is going to be settled anytime soon. So we can all look forward to another 6 months, a year more of heated debate on this issue, which I know will excite everyone. All right, let's move on to some interesting side of the space when it comes to asset allocation. Obviously, a big focus of this show, and a question we get a lot, and in different modes, different frames, is hey, I'm a straight up long only equity guy, or I'm a 60-40 or whatever the breakdown is, but a lot of equity exposure, or maybe I'm commodity, something else. How should options really come into my portfolio? What percentage should they be? What kind of allocation should I give to them? Should they be kind of just lumped into all this big general alts ghetto, as some people have termed it, and you get like a sub 3% allocation, or should it be more to it than that? And so I know, Mark, one of the reasons we had you on today is because you've done a lot of research into this, as is your wont over there at Swan. It's kind of your purview there, the research side. But I know you've been looking at this quite a bit, and in particular, because obviously this pertains to you guys over there at Swan a lot as well. Where do you see, the heart and soul of this show, the options-oriented part of our portfolio? What role does that play? How much of a component should it be? How should the typical advisor, asset manager who's traditionally long only, how should they view this? Maybe where should they even start? I'm sure it's probably an overwhelming topic to even approach for a lot of them. So take it away. I know you've written extensively on this recently. What are your thoughts on this, shall we say, pretty deep topic?
Yeah, I appreciate that. As you mentioned, Mark, that is the topic of a recent white paper we published at Swan at the beginning of the year. It's entitled Where the DRS Fits in the Portfolio, or Where Does Hedged Equity Fit in the Portfolio? And when it comes to this portfolio construction stuff, I think the basic tenets have been established for, if not decades, generations. Mark was the one who originally came up with these groundbreaking ideas of mixing and matching different assets with different correlations to lower your overall risk. But obviously, things have evolved over the years. Things have changed. I think diversification, modern portfolio theory, the efficient frontier, MVO, and any of those things you want to call it, went through a crisis of faith or a existential crisis in the financial crisis of 2007 to 2009. A lot of people were asking, does diversification even make sense? Because all these portfolios went down much more than the worst case scenarios would have anticipated. My opinion, my research and my own personal opinions, is that there's nothing wrong with the idea of diversification. In fact, the idea of diversification is good and it's something you should pursue, but it's all about implementation. It has to be done correctly. What I believe is that a lot of people pursued what I would call false diversification prior to the crisis, where they might have 18 different equity managers covering all the different style boxes and splitting their hairs so finely. And of course, at the end of the day, if everything's up at the same time, then everything's going to be down at the same time. So, really it's about making sure that the tools in your toolkit are better and are actually going to complement the traditional holdings in the portfolio. Now, of course, post-crisis, things have evolved. We've seen tons of these liquid alt strategies made available. And in 2016, I think we really saw a watershed moment where, well, a couple things. Morningstar created an options-based category that was dedicated to different funds, different ETFs that produced different option-based strategies. And then they also released that 3x3 alternative style box to complement their style boxes in equity and fixed income. So I believe we're kind of at this point now where a lot of FAs or investors are at the now what point in the process. They realize that their old stock and bond toolkit is lacking. They've got these new solutions available to them. The solutions themselves are more broadly accepted. So the questions really are, like you mentioned, how much should I put into a portfolio, and what is the role that an options-based strategy should play in a portfolio? But before we just dive into those, I think one of the questions that's maybe even broader than that is, when it comes to building a portfolio, this idea of portfolio construction, the real question is it a science or an art? Is it an art or a science when it comes to putting together a portfolio? And my belief is that for too long, people relied too much on the numbers. They treated it too much like a science. They would take an optimizer like Ibbotson or Frontier or Allocation Advisor and just blindly follow whatever the outcome of those allocations were. And if you do that, well, then those two questions that we're going to discuss here are kind of moot, right? If the optimizer tells you the optimal amount is 31%, it doesn't really matter what the role is or what you think it should be. That's what the optimizer tells you. But obviously, I think that approach is dangerously naive, especially when it comes to liquid alts and especially when it comes to option strategies. As you kind of alluded to, Mark, liquid alts is a grab bag of anything that is not a stock or a bond. So the drivers of risk and return can be wildly different. Even within, say, for example, like option space, the types of strategies can be very diverse. There's a ton of difference between the strategy that collects short put premium on a 1 week basis and then someone who does maybe like a collar strategy. So we would probably all agree that that's a good thing that you've got so many diverse ways you can use options and everything, but it puts the onus back on the financial advisor to really understand what are the risks, what are the drivers of returns, and then, how can we use these things? So I believe that, the art is every bit as important as the science part, and maybe even more so when we start talking about liquid alts and options.
Yeah, I think, we'll get to all the liquid alt stuff in a little bit as well, because you're right, it is kind of I kind of refer to it almost as a catch-all category, which I'm not a huge fan of lumping everything together because so many of these things are so disparate, as you pointed out. But we'll get to that in a little bit. I know, Mike, you have some thoughts on this as well. This is obviously an area that is near and dear to your heart. So what thoughts do you have on, first off, on just kind of this general approach to, asset allocation in a portfolio, and where, or even really what role do you think options should play within that, 100%, 5%, and maybe also to drill it down to a more specific topic as well that I'm sure is near and dear to the hearts of a lot of our listeners. I know the Swan guys, you deal with this all the time. Mike, you deal with this as well. I think a lot of our listeners coming to this going to looking at the options portion of their portfolio probably as providing some sort of protective component, some sort of protective element. So the flip side of that coin, though, is when you're doing that, when you're allocating resources of a portfolio to that, you're inevitably going to get those angry calls when you're buying puts in Apple, shall we say, or the SPY, and it rallies, 7 or 10% over the last few months. They're going to call you up and say, why are you wasting my money on this, on these hedges? So maybe a two-pronged question for you there, Mike. First off, in general, where do you see options fitting into the overall portfolio allocation? And then B, if you are going to go down that protective route, how do you deal with, shall we say, some of the client feedback that's inevitably going to come your way?
Two excellent questions. First off, in terms of what role options play, I think it needs to be very customized to people in that I do a lot of group trading for my clients, but there's a lot of overlap that's involved. So, for example, let's say I think that one client should have have 5% of this stock, another client might have 10% of this stock in their portfolio. That's all very customized in my view. But where it needs to be, where I think it really needs to come in terms of what role do options play, an old time. I'm oversimplifying this rule, but the oversimplified allocation rule is that you take a client's age, and that's how much money is in safe assets. So, for example, if a client's 20, then 20% of his assets should be in safer assets, and I'm making air quotes just so you know what's safe. And then 80% should have long-term market exposure. And of course, as the client gets older, you have less market exposure and more, once again, air quotes are being made, safe assets. I believe in that to an extent. In years past, oftentimes people would say, okay, client's 50, put them in 50% stocks, 50% bonds, call it a day. Well, the problem is that bonds stink to high heaven right now, in my opinion. And we can talk about that all we want, but the reality of it is that we're in a very low yield environment. And interest rates might not be coming up. We can debate all we want about when the Fed's going to raise rates, but interest rates probably aren't going to be coming down. So for that, I have a hard time putting clients into bonds. I would say with all the assets with which I manage, I probably have maybe less than 10% of bond exposure, and I have a lot of older people. So you might say, holy crap, Mike, well, what do you put the people in that fall into the safe assets? Why not bonds? Or what instead of bonds? Well, I've talked about this on the option block many times. One example is I'll do a very tightly constructed collar. I'm bullish on silver is one example. That was one to where I put on a very tight collar probably 3 or 4 months ago. I have a looser one that I put on maybe 1 month ago, but 3 or 4 months ago, silver was at like 1802 or something like that, SLV. And so we went out about a year, and for no cost, we were able to sell a covered call at the 20 level and buy a put at the 18 level. So we had very minimal risk. I mean, we're talking probably about a 1% risk for the potential of a 10% gain over the course of a couple of years. Now, of course, if silver goes down like it has, then, well, we lose our 1%, but I feel a lot more comfortable in something like that. And I have a ton of examples like that of how I'll do things with collars, whether it's on stocks, whether it's on commodities, whatever the case may be, as a replacement to bonds. I think that's one to where it plays a huge role in what I do. The other question was that what do you do when you have an angry client when the market's going higher and you're buying all these protective puts? Well, this is just a fact of life, and I don't know of any way to get around it. The hedger's always the most unpopular guy at the party. Hedgers, politicians, and head football coaches and quarterbacks, I think, all have the same lot in life, in that they get more credit than they deserve when things are good, and they take more heat than they deserve when things are bad. And by good, I mean that's when the market's going down. So I just got to live with it, and I tell clients that from the get-go, and I try and be as open and as honest as I can with them that if the market goes higher, we will underperform in this, but if the market goes lower, then this is going to be of benefit. So I think the way that I answer it is that I have constant open communication with my clients and try and do very good with that, and that's typically how that works out.
Randy, same question for you. Obviously, you've been dealing with this for quite some time, 15 plus years. The centerpiece of your DRS actually is, of course, the hedging component. So you've been taking these calls from people for quite some time. What do you say to the clients when they call up? Because I know a lot of our listeners out there are going to have to deal with a similar scenario if they take our advice and do what we advocate on this program. So what advice do you have for them in those scenarios?
Well, look, I always start off, and we talk about our stated goal as money managers and what we're trying to do for our advisors and our clients is, hey, we think we're a full market cycle strategy, and that means a bull and a bear market. So evaluating us over a very short period of time or even just in a bull market, we think over long haul would not be prudent. And if you get into the concept of can you really effectively time the market or pick stocks, that goes against our firm philosophy. And so we always go back and say no one knows exactly how long this bull market is going to last or when the next bear market's actually going to start. And we could have had the same argument 3 or 4 years ago after you had a 3 or 4 rally, and the traditional bull market lasts about 3.5 years. And so could easily said, let's get out of the market and wait around. So we always have a fundamental philosophy of always invested, always hedged long term. Now, when you get back into whether or not someone actually can predict the market, we always go back to rational exuberance, which was spoken for the first time in, I think, November, December of 1996 by Alan Greenspan, who theoretically is the smartest guy in the smartest room at that point in time. Yet it took the market another 3.5 years to get to the top of the market. So I always go back to always invested, always hedged. But also, I think Mark and Mike at our firm have done a lot of research on this, and this goes back into the paper that we were talking about earlier in the show is, what kind of allocation and what does a hedged equity type strategy do, regardless of the underlying asset you may be applying that to, what does it do to your portfolio? And so I want to bring back Mark into the conversation actually and talk about what kind of research we did to kind of offset that concept of underperforming an upside and what you're really doing for the portfolio in terms of return and risk.
Sure. So, when we went through our research and looked at different allocations, we added the defined risk strategy, which, of course, is a hedged equity approach to both a basic 60-40 portfolio as well as a more balanced portfolio of 8 different asset classes, which included things like small cap, high yield, emerging markets, cash, bonds, the usual suspects. And in each case, at around somewhere between a 50 and 80% allocation, the traditional metrics that one would use to judge the suitability of a portfolio all improved, whether it was, Sharpe ratio, standard deviation, max drawdown. So obviously, to get back to one of the previous questions that Mark asked, what is the optimal allocation? Well, it's enough to make a difference, right? I mean, I think you mentioned that sometimes at the end of the day, people only get like a 3% allocation. Well, that's not really going to change things, right? I mean, it's nice that you have a little slice there to something that's different, whether you want to call it a liquid alt or whatever. But at the end of the day, that's not really going to have an impact if 97% of the portfolio is what it's always been. As far as different roles, I think Mike did touch on one of them, which is as a fixed income alternative or a fixed income surrogate. Bonds have traditionally performed a dual role in a portfolio where it was income and capital preservation, right? And throughout most of the 80s and 90s, even into this most recent decade, you were able to get both of those. Now you get neither, or you have to pick one of the two. So whether you're doing some type of a hedge, some kind of protective put type strategy to protect on the downside, or you're doing some kind of premium collection thing to help generate some income, I think that certainly a hedged equity approach as a fixed income surrogate or replacement makes a lot of sense. Now, of course, you have to look at the other constituents of the portfolio and figure out, okay, where are you going to take from? What bets are coming off the table, and look at how these things interact. But certainly, I mean, that was one of the 3 or 4 things that we identified in the paper was the idea of option-based strategies being a fixed income surrogate. Some of the other ones that we discussed, I mean, you could say that it is a core equity position. I mean, if you have, say, for example, a large position in SPY or some other kind of large cap holdings, and you put a little bit of options around it, at the end of the day, the primary drivers of the performance will still be whatever is driving that large cap market. So you can say, yes, we still have a core equity exposure, but we're just changing the risk return profile around the margins a little bit. Again, there's different ways you can implement that, whether it's taking off some of the downside risk or adding a little bit of income on top of that. But fundamentally, if you were to look at the price earnings ratio, price to book ratio, all the portfolio based characteristics, you could make a very strong case that it's still a core equity position with some changes around the margin. And then finally, the other way that we would say this, you could treat this as an alternative and treat it as something that's entirely different than your traditional equity or fixed income, simply because the tracking errors, the standard deviations, all these various covariances and correlations might be so different that it needs to be treated as a third leg to the stool. And that's fine too, if you want to do that. But it gets back to the other question about allocation, because too often what we see is, most advisors might put 10, 20% in their alternatives bucket, which really isn't enough to impact things. I mean, it's going to help a little bit. But as we mentioned, our research shows that allocations of upwards 50% or more are where you really start seeing a meaningful positive impact on things.
Yeah, a bunch of good points in there. Actually, I think that's a good thing to make up. You brought up actually as well regarding the impact on standard deviation and the volatility of the portfolio and the Sharpe ratio, because those are all things. Getting back to that question I asked earlier, that you can actually respond to that angry client with when they're calling you up and saying, "Wow, how come the market is rallying? You're spending money on hedges." You can kind of refer back to the impact on the Sharpe ratio and the risk-adjusted nature, the reduced volatility. These are all beneficial things you could point to even in an up market that can maybe help keep that client interested until the inevitable downswing comes and that put really kicks in. Of course, back to your other point there, Mark, though, if only 3% of the portfolio is allocated to quote-unquote alts and some small percentage of that 3% is actually in a put, 97% is still long equity. It's not really going to move the needle or save you when you need savings. So that gets back to that earlier conversation about how much do you actually allocate. Russell, you literally wrote the book on this topic with option strategies for advisors. I should say a very weighty tome it is indeed. I recommend our listeners reinforce their desks when they put this book on it, because it is a mighty tome indeed. But that said, this is a kind of a central question for this audience. How much in general should they be allocating toward options, and what should they do with them within that portfolio? So how did you tackle this when approaching your weighty tome, sir? And what are your thoughts on this subject?
I swear, when somebody buys that book and they complain about how short it is, I'm giving them your home address.
They can call me for their refund.
I'm just letting you know. With respect to options, it really does. It depends is kind of the answer as far as the classification for them. But you're really what you're really kind of shooting for when you're taking money on for clients is making sure you understand what they want. And I'm teaching portfolio management at one of the local universities right now. And something that I have drilled into all of these about to be finance graduates is that you want to do things in a way that you never get sued, which sounds like a complete deviation. But the way that you go about doing that is you make sure that your client is fully clear on what you are doing on their behalf, and you have it documented. So when you've taken 3% of a portfolio and purchased some sort of portfolio protection for a year because a year ago your client told you that they were worried about the direction of the market, and you agree to do something like that, you can remind them that it was a team effort, and which it should be. So, where it fits, it just depends. It depends with respect to what the mix is already. I don't really think it belongs under alternatives. I just think it fits in as the risk management tool that alters the different traditional asset classes.
Yeah, I mean, when you're buying a put on your equity portfolio, everything else is remaining the same. Is that really an alt? I agree with you. I kind of hate to. That's why I refer to it as that ghetto. It gets lumped in there, and it kind of gets lost amongst all these other, shall we say, more esoteric asset classes. When in reality, you're buying a put on an equity. That's pretty straightforward. But c'est la vie. This is an interesting conversation. Obviously, could fill the whole episode with that. I think we'll be returning to it soon. In the meantime, if you want to check out more about that, or check out Mark's research on this topic. It gets pretty extensive on this subject, graphs of the Sharpe ratio, all this cool stuff. If you want to check out the visuals for yourself, head on over to Swan Global Investments, or just search for where the DRS fits in a portfolio. That's the name of the article, and that will arm you with that information. I know a lot of our listeners, they like data, they like graphs, they like data they can actually sit down and show to their clients, so I think that could help you along those lines. Speaking of data, our friends over there at OIC always send us interesting studies and data and releases, and they put out something recently just kind of, I think, extolling the virtues of the financial advisor and how important they are, I should say, really to their roles going forward. I mean, OCC really started, obviously they're a clearinghouse, but OIC's really main mantra in the early days was educating retail. They still do a lot of that, obviously, but financial advisors have become a huge part of what they do, as witnessed by Eric and their team and Frank. Just they're hither and yon all over the place at every event they could possibly be at, really just spreading the gospel of options. Along those lines, they were pointing out some data from Cerulli Associates saying that about 285,000 financial advisors in the U.S., about each of them averages on average 150 clients. So they have substantial influence. They also say only about 9% of those actually use or recommend listed options to their clients. So still obviously a long way to go on the penetration front. Interestingly enough, though, just as we were getting ready to record this show, another article came out, I believe this one from CNBC, citing some different data. I think they're kind of conflating financial planners and financial advisors, which happens a lot. But the title of their article was essentially "Financial advisors is a hard job, among the toughest jobs in the nation to fill now," which is kind of interesting. So they're saying that effectively there aren't enough financial advisors out there to meet the demand. According to their numbers, which is from CareerCast, they cite about 76,000 with 8 term certified financial planners, but they kind of use that term advisor and planner interchangeably, which we see a lot. So I'm leaning more maybe towards the OIC's number. But that said, they said that's not enough to what they term meet the demand. And also part of the problem is not just what OIC cited earlier, that only a small fraction are actually using options, but also that this is shall we say, a graying demographic, the advisor demographic. A lot of these guys got into the business years ago. Of course, in recent years, we've seen the rise of robo-advisors and other things that have kind of pushed maybe some new entrants away from the field. So as a result, we have an aging demographic actually doing the advising and not enough new blood coming into the space. So from our perspective here on the show, actually 2 challenges facing the advisor community. One is still, in spite of the broad reach of the show, and we love all the guys who've listened and written in, we know it's a huge audience out there in terms of still the available number of advisors who don't use options. So expanding the reach to those people is challenge number 1. And then B, just getting more of you. How do we get more of you? Because these are 2 challenges that if we don't meet both of these, I have a feeling retirement will look a lot different, and planning and investment management will look a lot different in the near future, and probably not for the better if we can't address both of these changes. I guess, Mike, we'll start with you because you're holding down the OIC hot seat today, so you get to respond to the OIC data. Well, what are your thoughts on the still relatively small number of advisors out there who are doing what you do, who are, rolling puts and selling calls and things for their clients? And then also this other, shall we say, a little bit more dire report coming out of CNBC just this week that we're in a bit of a down market for financial planners / advisors, and how do we get more of them, particularly of our kind, of the people who like to use options. So a lot to bite off there, sir. Start where you will.
I mean, it is a job to fill in that no matter what, most advisors have to start off with no assets. They start off with no pay, and you have to beg people to give you money when they know you're just starting off and you're a financial expert who doesn't have enough income to get by. It's a very tough road to hoe to get into it. So, there are wirehouse opportunities that you can get in, use the Goldman Sachs name, the Smith Barney name, whatever the case may be. But the problem is that then you're kind of just a glorified employee and you're not making it on your own. So at this stage, it is a hard thing to get into. And I don't know if the way things are right now, I don't know if I would do it again. Glad I'm doing it now, and I never intend on quitting, but man, it was hard getting in, and it's a lot harder now, I think.
Randy, I know you probably have some thoughts on this as well. Obviously, you've been doing this for a while. There's obviously a lot of ground to cover there, not just the dearth of advisors who are using options, but also, as Mike pointed out there, kind of the challenge of getting started as an advisor out there. We have to go out, you have to gain AUM, and something maybe a lot of guys aren't comfortable doing. In addition to having the skill set to manage those assets, there's a lot of challenges there. Even Mike, who's been doing this for a while, saying maybe he wouldn't do it again, which is interesting. So what do you have to say to those interesting challenges facing the advisor community going forward?
Well, let's first talk about the opportunity I think a lot of advisors do. Going back to your number of 9% of advisors use some form of options in their practice. I think that's a tremendous opportunity for the individuals that are willing to kind of learn about options and trying to implement those, because I think that's a value add in the practice. I think all our research done over the last 5 or 10 years all point to options being a value add in portfolio. So I think that's an opportunity for a lot of advisors. So I think just since we've done this radio show, and Mark, since I've known you, we think there's been a tremendous increase in people willing to even use options since the most recent financial crisis. I think on the second part about more advisors coming into the space and how they're going to replace all the advisors that may be retiring over the next 5 to 10 years, it is an issue that I think is going to have to be dealt with. I think you've got the rate compression, the DOL, various other people fighting over for the fees that are out there. And so I think that's kind of one of the movement on the robo-advisor has always been predicated on maybe some of the science or math behind designing and building portfolios isn't something that people in the end are willing to pay a lot of money for. I don't necessarily agree in passive investments per se. That is something that I think that is going to be worked out over time. I think the financial advisor really needs to build their practice and base it on some value add in terms of financial planning, estate planning, stuff like that, where the robo-advisors really can't go to right now. They're trying to come up with the most cost-effective way to build a portfolio. And of course, one of the things that I always talk about is just applying the passive approach to portfolio management ultimately probably leaves you in a very efficient way to lose money during the next bear market. So I'd just like to end on that and let someone else jump in.
Yeah, I should point out, too, that number 9% is from the OIC study from 2015. They haven't completed their 2016 survey yet. I have to believe that number would be a little bit higher. Just from hearing the feedback we get from the show. I know there's more than a few of you out there who are starting to hear the message, and certainly, as you mentioned, post-downturn and everything else, and certainly in the tumult, the beginning period of 2016, where there's a lot of volatility out there, I think a lot of people saw the need for some sort of protective activity and hedging of the volatility of their portfolio, if nothing else. We've been talking for a while here, so I want to make sure we get to this one because we kind of touched on it earlier, so we're going to jump ahead a little bit to this topic, because I know this is going to come up with some of our listeners out there as well. They're seeing all the same headlines we are. Now, of course, it's the beginning of a new year. We're seeing the numbers come in from 2016. A lot of the headlines we've seen, a lot of the big, advisor-oriented sites, your pensions and investments, your FAs, your others, all kind of have a similar headline. This one was liquid alts end year, so-so year, up 2.3%. There's a lot of headlines talking about this, as I referred to it earlier, the alts ghetto having kind of a lackluster year last year. So I know this kind of thing is going to obviously put off, when they see this, some of the advisors who look at this and they immediately lump options into this discussion. Oh, this is part of the alts. Alts did terrible last year. I'm not going to do this. Let's break it down a little bit and see what their findings were. They looked at here. They said 39 new alts funds were launched in 2016. 82 were shut down. This is data coming out of Wilshire. That means the total number of funds for 2016 was 5 alt funds that they tracked was 527. That's with 82 being liquidated during the course of the year. Liquid alternatives finished the quarter flat after gaining just 0.2% in December to conclude what they term a lackluster year. This is the Wilshire Liquid Alternative Index, posted again 2.3% gain for the year. That's compared to 12% for the S&P, 2.7% for the Barclays Bond Index. The best, according to them anyway, their best liquid alt sub-strategy, because you have to really get into the sub-strategy to see what they're talking about here. All of alts, they don't really go together. They said it was relative value that comprised credit, convertible arbitrage, and vol funds. It makes up 36% of the Wilshire Index. It finished the year up 4.4%. The worst performing was Global Macro, finished down 2.1%. They say also liquid alts assets decreased for the year by about $8.5 billion. That's in the fourth quarter, actually, being net outflows for the year to nearly $35 billion. And total AUM for liquid alts stood at about almost $290 billion. That was down from $324 billion roughly at the end of 2015. So all in all, not exactly the best year for liquid alts. Of course, you break it down a little further, the top 10 liquid alts funds that they mentioned, there are some here that you have to assume utilize some options in some components. You have the BlackRock Strategic Income, assuming that would, of course, utilize. Again, you never know until you break into the perspectives of these things. It could just be a bond fund like many others at the end of the day. We have a Crescent Equity Hedge one. We have a Managed Futures strategy, Managed Futures being one of the interesting alts that also often gets lumped in with options-oriented type things. That one had about $12.2 billion under management. A lot of other funds that they break down here. We won't get into all of them. But still kind of interesting, and it kind of gets back to this argument we were talking about earlier with Mark and his research about, where do options fit in their portfolio. If you already view options as an alt, that means you're already limited to whatever your alt allocation is going to be, which is probably going to be sub 10% of your portfolio. So the options impact is going to be negligible. So maybe the first corollary to this data is how do we get options out of this alts ghetto, a common refrain in this space? And then B, what do you guys say when people approach you, with this data and say, hey, I don't want to go after your hedged options portfolio, say, for example, or strategy, because, well, that's an alt and alts didn't do well last year. How do you guys respond to these types of data? Maybe Mark, we'll start with you because you're the man with all the data. What do you guys normally say when you hear these types of arguments and options always being painted with this alts brush?
Yeah, well, it's a little bit unfortunate right now where, for the last 9 years, maybe fortunate or unfortunate, I guess, depending on where you're invested, but, the S&P 500 has been up about 250% since the bottom of the market. So if you were doing anything else, even what the textbooks say, traditional diversification, you're going to be answering the same questions. People are going to be asking, why do I have foreign in here? Why do I have commodities in here? Anything other than the S&P 500 over the last couple of years is going to be viewed as a detriment to the portfolio. It is hard to kind of bridge that gap and have people understand the numbers, the correlations, and things like that when so many people don't really digest numbers as well as the financial advisors out there. So, one of the things I like to do, actually I closed my paper with this, is I used an analogy about increasing the allocation. It's like every year, whenever I go to my doctor, she always busts my chops about not eating enough vegetables, right? She's always on me about my diet. And, originally I would say, like, yeah, I have a salad every once in a while. And she's like, that's really not going to do it. That kind of marginal improvement isn't going to change your health or change your cholesterol or any of that kind of stuff. You really need to make meaningful changes to the allocation of your diet in order to see a positive impact on things. And, if it was up to her, she'd probably have me be 100% vegetarian, but realistically, that's not going to happen. I still like my Philly cheesesteaks and whatnot. So, for me, it's just a matter of balancing things out because, yeah, the downside risk, the catastrophic risk of some major event like my heart blowing up on me is too high if I don't make some of those changes. So, you do have to kind of stretch out and tell some of the stuff in more of a way that people can get their arms around. And, that's one of the ones I tend to use.
I like that. Options are the veggies of your portfolio. I don't know if that's going to get more people to embrace them or have them running, screaming for the exits, thinking of cauliflower and Brussels sprouts and all that fun stuff. But I like it. Alts Ghetto, the veggies of your portfolio. Take your pick. Either one, perhaps suitably off-putting. Randy, same question to you. Obviously, this is one you guys deal with a lot over there. First off, kind of maybe breaking free of that alts label. How do you guys deal with that? And then also, B, how do you push back against, data like this that I'm sure you guys are hearing about already? Hey, alts were a terrible year. Why should I increase my allocation to a strategy that I term to be an alt?
Well, first of all, I always start off by explaining that when I designed the strategy in 1997, it really wasn't an alt. I think that category probably didn't even exist at that point. It was really a replacement to the traditional 60-40 portfolio. So that's why I always start off with the philosophy or the reasoning behind what we did, what we were going to do. And then I also point towards, hey, if you believe in diversification, and Mark made the point that, we've always said diversification is part of the solution. It's not the entire solution. You've got to have some more active risk management in your portfolio. And so I think it's always unfair to say, hey, the S&P's been up 260%, as Mark said. I think that was the number since the lows in 2009. And compare everything to that. You'd have to look at a more broad-based portfolio. How does those broad-based portfolios really perform during that time period? And I used last year as an example. Obviously, the S&P 500 had a really good return. Foreign developed was pretty relatively flat. Bonds were relatively flat. So what did your portfolio do, just the 60-40 portfolio? So it's always, I think, unfair comparison to go back in that. We have our clients use us in every which way. So we are a replacement to a portfolio in some people. We are getting cash off the sidelines to other people. We are a fixed income replacement, and we're definitely a core portfolio. So although we are often put in a alt bucket, the reality is that the way advisors and clients really actually use SWAN and our products across various assets that we apply our strategy to ultimately is a much more significant, meaningful impact because they get it. They get that adding 2% or 3% of a portfolio isn't going to really do much to your risk management and ultimately provide a lot of value in terms of lowering standard deviation and increased returns over time.
All right, insane question for you, Uncle Mike. You guys get this question a lot. Obviously, you probably also, like Randy, those guys kind of rail against being lumped into that swan. That alts rubric, that alts umbrella. So, what do you have to say when you hear this kind of numbers thrown at you and people say, "Hey, I don't want to be part of that because alts haven't done too well"?
Right, and I agree in that. You have to differentiate yourself, and that's the most important thing. I mean, oftentimes when, even on the option block a couple years ago in my great Apple run, so to speak, the Apple collar run, a lot of clients in Apple would call and talk about, well, why am I in these collars? They're going up. Apple's just going to go straight up. And it was a lot of education involved on my part. But ultimately, at the end of the phone call, it typically worked out for the best. I think the same holds true if you're getting lumped into something that you're really not a part of in the first place. Everyone watches the Dow. And when the Dow is up, well, how come my portfolio is not up that much? And if the Dow is down 20% and we're only down 4%, why am I losing money? You have to be prepared for that type of phone call. And you have to consistently have open communication with the client. And if you have that, oftentimes what that does is that helps educate the client to realize that we're not part of the alts category. Last year for hedging on my SPY hedges and strategic night hedges, it was the best hedging year of my life. For a while, we're as far into the year as September, we were actually ahead on the year in the hedge when the market was up. And granted, we got lucky a little bit in January with some of the market movement, and overall, it still turned out to be one of the best years. I think it was the best year I've ever had in the hedging world. But so in terms of hedging an equity-based portfolio, I had a great year last year. And then when I can point that out to the clients, then that really helps things out. Now, obviously, other years you're never going to have your best year every year, obviously. So even when you're down a little bit from what you're expected to be, you just have to explain what's happening, what's going on, and why it's happening, and what you plan to do to grow from it and learn from it. And maybe it was just part of what was factored in to begin with. And at the end of the day, Mark, it just comes down to having good, open, honest communication with clients very frequently.
All right. Unfortunately, that music means we've come to the end of yet another episode of the Advisor's Options. Hard to believe it's over already. So many great topics to get to. I apologize we didn't get time to get to your questions, listeners. Maybe we'll do an all questions episode one of these days because some of you guys write in and I want to make sure you get in. But again, so many great topics to get to. We just didn't have time for them this episode. But before we go, let me go around the horn again one last time. Checking with my cohorts, my partners in crime here on the panel. Mr. Rhodes had to go, unfortunately, over there, Director of Education of the CBOE. But check out his book. It is Options for Advisors and Institutions. You can find it to search for his last name on Amazon, Russell Rhodes, Rhoads. And you too can pick up that weighty options tome. Don't get mad at me for saying that, but nonetheless, you should do it. Interesting book. And, of course, Uncle Mike, you too have a book called Going Long. Where should folks go? They want to check that out.
It's on Amazon Kindle. So download it to your Kindle app. It's Go Long, New Option Strategies for Buy and Hold Investors. It's a second edition with 2 recently written chapters on both portfolio margin and weekly options. Check it out, folks.
And, of course, our friends over there at OIC couldn't be on, but check them out over there at optionseducation.org. where you too can check out, there's an advisor tab all the way over there on the right-hand side. Click on that. You'll have to register, but once you do that, you get access to all this great data. We just touched on some of it today on the show, but there's a lot of it over there. Studies on collars and puts and all sorts of other things, and optimal portfolio allocation, getting to what we were talking about earlier. So a lot of great stuff over there. Check it out. It's all free. You just have to register. optionseducation.org. And, of course, our friends over there at Swan, always holding down their own great education over there, including their 10th box events. I believe you have a couple of events coming up here, Randy, including one in St. Louis on February 28th and in Illinois, Oak Brook Terrace, actually, our neck of the woods here on March 1st. Easy for me to say, March 1st. So where should folks go if they want to learn more about those events, as well as all the great data and studies you guys have coming out? So where should they go? What should they do?
Well, swanglobalinvestments.com is our website. We've got an entire library of everything all the research that Mark and other people at Swan do is all put up there on a regular basis, as well as our blogs and our quarterly newsletters. So that's always the best place. In terms of the scheduling of events, I think that's also on the website. So absolutely, if anyone is in a particular area, I think we're committed to having the 10th boxes in most of the major metro areas around the country throughout the year. So we're never that far away from showing up at a 10th box.
And you have a big one coming up, I believe, down the road in Chicago. You're actually moving the big symposium from Puerto Rico to Chicago this year. Is that correct?
Absolutely. I think we're pretty excited about the event coming up this year. Last year was our first one. This year, I think we're expecting probably about twice the size. So, yes, it is going to be in Chicago this year. I think it's a much easier for people to get to than Puerto Rico. It's not as pretty, not as warm, but that's the way it goes sometimes.
At that time of year, April, kind of hit or miss. Could be beautiful, could be terrible. I guess you have to roll the dice and find out. If you want to find out for yourself, Randy, of course, mentioned the website. If you want to specifically look at the conference site, it's 10th, so the number 10, thbox.com, 10thbox.com. You go there, and that will help you find when the next event is coming to your area, and hopefully you can make it out here to our neck of the woods for the big event coming up soon in a few months here in Chicago. Looking forward to that. And on behalf of Randy and Mark and Mike and Russell and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. Of course, sending in such great questions. We'll get to them soon, I promise you. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.